Welcome to Momentum Trading Group. This is going to be just basic market basics. Just going to walk through just some general ideas for you. If you're new to the stock market or new to investing or new to futures, this just is a general outline. Shouldn't be too hard. So getting started. The hardest part is getting started. This is true of anything. When you start taking something new, there's going to be a little bit of a learning curve, and that's really what the focus of this is going to be about. So what we're going to cover today is really an introduction to the financial markets, types of analysis, tradable instruments, and then an interconnection of the markets. So very first thing we want to look at is how big are the markets around the world, because really we are in a global economy. If you look at the Forex market, it is the largest market in the world. This is our currencies. So trades about $4 trillion a day, and you can see all the way to the far right how that compares to the U.S. global stock market. So you can see that it's so much larger than everything else out there, but so that's one of the first things we always want to look at is how are the currency markets, how's the US dollar against, let's say, the Japanese yen, which we're going to cover in a little bit more depth. So basically two schools of thought whenever you're learning about analysis is there's fundamental analysis and there's technical analysis. Now fundamentals is really where you dive into the meat and potatoes of a company, right? So you're looking at it and say, okay, what's the value of this company from a fundamental level? Technical analysis is more along the lines of what the trends are, kind of a perceived value, if that makes sense. Just one of the things that we'll look at. Fundamentals basically breaks into three separate categories. You've got the economic analysis. This is kind of, how are things doing from a global perspective? How's the U.S. economy versus other places? Things like that. Second thing is industries and sectors, and these are particular areas of the economy that companies do the same thing. An example would be like Apple Computer, Dell, IBM, things like that. Companies that do similar products and services, or maybe retails. So, places that you go buy your clothes and things like that. Those are kind of sectors or industries in the economy. And then the company, how's that company doing relative to the sector and relative to the economy? Is it outperforming? Is it performing in line? Is it underperforming? So those are just some basic ways that you can analyze a company. We don't pay much attention to this, though. From an economic standpoint, we are aware of different reports that may come out because that does create what we refer to as event risk. So we want to be aware of certain events that could come out or news announcements, things like that. Technical analysis is really more of a behavioral finance. It's the measure of greed and fear in the market. And you've just got to remember that fear is a stronger instinct than greed. So markets always fall faster than they rise. So it's just one way you can kind of gauge the overall sentiment of the market. Is it uptrend, downtrend? Is it sideways, whatever? And that's what you're going to cover a lot of in the chart analysis. And then the trend patterns. What is the current trend? So we're going to talk more about this in some later sections. But this just kind of gives you a basic overview. The four products that we focus on is going to be the S&P 500, which is just the largest gauge of the U.S. economy. The Japanese yen, which is a lot of people refer to as the carry trade. They'll look at how the Japanese yen is doing versus the U.S. dollar, and it kind of gives us a real good gauge of money's flowing into the U.S., money's flowing out of the U.S., or that sort of thing. NASDAQ 100, these are the largest momentum style of stocks. These are the Googles, the Facebooks, the Netflix, the Amazons, those types of companies that we're all familiar with that are tend to be growing at a fast rate. And then crude oil. Crude obviously is extremely important because it really is, I know the dollar, everything is tied to the US dollar because it's when you buy or sell crude, you've got to buy it in US dollars, but it really is the world currency, crude oil is. So a couple of key statistics about the S&P 500. Average daily volume is about 1.5 million contracts a day trading. ATR just stands for average trading range. It's how much it tends to move, how many points it tends to move per day. It's about 20, and what that means is that per point, there's 4 ticks in a point. So per point, that equals $50. So if you look at an average trading range for, let's say, and we're going to cover this in a little bit more depth, but if you look at the average trading range at 20 points, you figure there's the ability to make about $1,000 a day. So you always want to get a feel for average trading range, what they tend to move, and how much you make per tick, or basically it breaks down into, with S&P, the yen, and the NASDAQ, they break, basically there's 4 ticks in a point is basically how they break down. Crude, basically it's 10 cents is the way that it's looked at there. So per tick you make, there's 10 cents in a dollar, so per penny. So we're going to look more about that. If you look at S&P 500, if you again look at the ticks, the ranges, it kind of gives you an idea of what the dollar amount or expected ranges that you can make per day on that particular instrument. The next thing we're going to look at is we're going to talk about how the markets really are all connected. If you realize the S&P is probably the best gauge of the U.S. economy, and below that you have the NASDAQ and Dow, and then below that you have sectors, and then below that you have individual companies. And you can see how these basically are connected. So we always want to get a feel for how's the NASDAQ influencing the S&P, and we're going to talk a little bit more about that. You're also going to hear us talk about that in the live trading room. The NASDAQ is outperforming the S&P. It'll tend to pull the S&P up. If the NASDAQ's underperforming the S&P, it'll tend to pull it down. So just kind of a gauge. And then we look at individual sectors of the market. You know, the S&P, for example, is primarily going to be energy as well as financials. So those are the two major sectors of the S&P. So how are they performing, or what are they doing? Because that can really give us a gauge of the overall markets. And then which stocks below those tend to be kind of the best of breed that really kind of drive the markets. And we look at that intercorrelation there. So one of the other things we look at is that all ships of ours are rise and fall with the tide. So if you look in the top left corner, and again, majority of stocks will follow their indexes. If you look in the top left corner, you can see that there's an index and it's overall in a general uptrend. And then you'll notice that two of the stocks within the same area of the market will also be in an uptrend, but not all of them will be. You can see this one's going down. It's not going the same direction. So this is a good gauge of how are stocks doing, how are sectors doing, because that's really going to help drive the overall markets. Okay? Just some basic information. You can see, though, that they'll still be correlated. You can see drops, bottoms, highs and lows. There'll still be a correlation even though the moves are down. The other thing we look at is relative strength, and this is what we were talking about earlier. If you look at the red line here, the red line here is going to be the NASDAQ. So the NASDAQ is pulling up the S&P. When the S&P or the NASDAQ gets weak, it drives that S&P down. Okay. Now, again, same basic correlation. You'll see how there's a couple of divergences here, but you'll notice the correlation change, which I'm just going to show you in just a second. See right there where the market's correlation change, where the red line was below the blue. So that pulled the markets down, and then all of a sudden you start to see where the red line goes above the blue, and that lifts the S&P up. That is a prime indication of how the NASDAQ is in relationship to the S&P and what we look for with the overall markets. Thank you.